We're going to tackle a question today that, it seems super simple on the surface, but the answer, it completely changes how you look at business, how you look at investing. We are diving deep into profit versus wealth, and we're going to figure out what a company's real goal ought to be. Let's get right into it.
So let me just ask you this straight up. When you think about any company, doesn't matter if it's the coffee shop on your corner or a massive global tech company, what is its number one goal? What's its ultimate objective?
I'm willing to bet your first thought was something like, to make a profit. And hey, you're not wrong to think that. That's what pretty much 99% of people would say. It just feels right, doesn't it? It's all about the bottom line. But what if I told you that's not the whole story? That focusing only on profit is actually a bit short-sighted.
Right, so let's dig into that first big idea. Why profit all by itself just doesn't cut it. Look, it's a huge piece of the puzzle, no doubt about it, but it's not the whole picture. And focusing only on profit can, believe it or not, lead a company down a really dangerous road.
Just think about it for a second. A company could pump up its profits this quarter by doing things that are actually terrible for its future. Maybe they slash their research and development budget to zero, or they stop training their employees, or they switch to cheaper, lower quality materials. Sure, profits look fantastic right now, but what happens next year, or in 5 years? The shareholders, the people who actually own the company and are in it for the long run, they see that, and it's a massive red flag. They know that short-term gains can often mean long-term pain.
And this is really where you see the two big mindsets clash. Profit maximization is all about the now. It's about asking, how can we make this quarter's numbers look as good as possible? But that can lead to cutting corners, like we just talked about with R&D, and it completely ignores risk. On the other hand, wealth maximization is playing a totally different game. It's a long-term strategy. It's about building a company that's going to grow and thrive for years, for decades. It's about being smart and managing risk. It's literally the difference between a sprint and a marathon.
So, if the goal isn't just making a quick profit, then what is it? Well, the real primary objective, the true north for any well-run company, is maximizing shareholder wealth. Now, I know wealth can sound a little vague, a little fuzzy, so let's lock in on a really sharp, clear definition.
And here it is. This is the big idea that changes everything. Wealth isn't just about the money a company has today. It's the value, in today's terms, of all the cash the company is expected to bring in for the rest of its existence. This forces you to think about the long game. A decision that boosts today's profit but torpedoes future cash flow? That actually destroys wealth. But an investment today that might hurt short-term profit but unlocks huge cash flows for years to come? Now that is how you create wealth.
Let's make this personal for a second. If I asked you right now what your wealth is, you'd probably think about your bank account, right? But your real wealth is so much more. It's the present value of all the money you're going to earn over your entire career. It's a much, much bigger number. And it's the exact same logic for a company. Its real value isn't just what it has now, but its entire future potential.
Okay, so this idea of maximizing wealth sounds great. It's forward-looking, it's strategic, but how on earth do you put a price on that? How do we measure this big, abstract idea? Well, that's where company valuation comes into play. It's the art and science of putting a number on that future potential.
Now, there are a bunch of ways to do this, but they pretty much all fall into three main buckets. You've got what's called the going concern basis, the breakup or liquidation basis, and then, of course, the simple market value. Each one tells a totally different story about what a company is worth.
And the real clash in philosophy is between those first two. The going concern approach assumes the company is a living, breathing thing. It's going to keep operating, keep innovating, and keep generating cash way into the future. That fits perfectly with our idea of maximizing wealth. The breakup basis, it's the polar opposite. It assumes the story's over. The company's being shut down and we're just selling off all the pieces for parts, the computers, the buildings, the patents. A healthy company focused on building wealth should always be worth more as a going concern than as just a pile of assets.
So, we know the goal is wealth. We know how it's measured. Now for the fun part. How does a company's management team actually make it happen? What does the day-to-day playbook for building long-term wealth actually look like?
For any company that's publicly traded on the stock market, the answer is staring you right in the face. It's the share price. A rising share price is basically the market giving the company a big thumbs up. It's a vote of confidence. Investors are betting that the company has a really bright future and that management is making smart decisions that will lead to strong, sustainable cash flow for years to come.
So how do they earn that confidence? Well, they focus on a few key targets that basically scream long-term health. They want to see consistent earnings growth, not crazy, unpredictable swings. They use debt smartly, keeping borrowing at a healthy, manageable level. And this is a big one. They hold on to some of their profits to reinvest in the company's future, funding new projects. All of this is done to increase the free cash flow that gives them the power to innovate and grow. Every single one of these is a signal to the market that they are building a company that's meant to last.
Which brings us to the final takeaway for you. The next time you're looking at a company you really like, or maybe when you've invested in, just ask yourself this: are they obsessed with juicing this quarter's profits? Or are they making moves to build something valuable and sustainable for the long haul? The answer to that question will tell you everything you really need to know.